Well, first, I don't think we surprised too many people by saying that the U.S. economy had declined after sometime early this year. But what was very striking about this downturn is, of course, its speed and its depth.
American consumers are feeling the pinch when it comes to the cost of food. Overall inflation is certainly easing or slowing, if you will, but new Labor Department data shows that the amount being spent on eating has hit a 30-year high. Restaurants and food company executives blame rising labor and production costs.
You've received news that the economy might be entering a recession, and boom, it rebounds strongly. As you're told, inflation is dropping, and it unexpectedly begins to climb. If you're finding the mix of economic signals perplexing, you're not alone. It's so confusing when some indicators contradict others. This is why I've researched the state of the economy. In this video, I will lay down all you need to know about the current U.S. economy. Although the U.S. economy is sending different wild messages, while the markets see reacceleration and another leg of the American boom, labor economists see telltale signs of a deepening slowdown and the risk of a serious recession if the U.S. Federal Reserve ignores the warnings. Let's see what Neuberger Berman Managing Director Holly Newman Kroft has to say.
What I do think is our 12-month outlook at NB Private Wealth is that we're going to have a significant economic slowdown and that the market is going to catch up to the indicators that have been signaling this for quite some time.
It isn't affecting the U.S. only. A protracted economic slump across large parts of the world is crashing into a really big debt problem, starting to seem like the risky lending of 2007. This strange contradiction will be resolved one way or the other soon enough. Let's watch this.
Well, as we keep an eye on your world this morning, switching gears here to two of the world's largest economies that have officially slipped into a recession.
This morning, officials in both Japan and the United Kingdom have published figures indicating they saw negative economic growth for a second straight fiscal quarter at the end of the year.
Germany, Britain, and Japan were all in recession over the winter. France escaped by a whisker but is now introducing austerity cuts. China isn't left out as well. The Asian country is still grappling with the fallout of its enormous property slump. That's not all. Cities and local authorities that once depended on land sales for 42% of their income have halved this revenue since that bubble burst in 2021. As for the U.S., total numbers in work have fallen by 898,000 over the last 3 months under the household survey measure, a shocking level of attrition that has pushed unemployment to 3.9% from its cycle low of 3.4%. Even the CNBC presenter was shocked when he presented that in this clip.
If you look at the unemployment rate, it took a jump to 3.9. 3.9. The last time we had an unemployment rate anywhere near there, you'd have to go to 4% in January of 22. So let's call it a little over 2 years. That is significant.
But investors looking for encouraging economic news found it in the gross domestic product growth of the U.S. economy in 2023. For the most recent reporting period, 2023's fourth quarter, the economy grew at an annualized rate of 3.2%. Here is a CBS News broadcast about that.
Some good economic news out this morning. The U.S. economy grew 3.2% in the fourth quarter of last year. That's revised down slightly from a previous estimate, but it is a sign that the U.S. economy is showing no signs of slowing down.
But the fourth quarter result followed a surprisingly robust annualized third quarter GDP growth rate of 4.9%. The economy grew by 2.5% in 2023, exceeding 2022's 1.9% growth rate. The American economy has been disappointing for much of the past half-century. Income and wealth growth has been slow for most families, and inequality has soared. Perhaps the starkest sign of the problems is that life expectancy in the U.S. is now lower than in any other high-income country, which isn't especially close. Even NBC had to report that.
Welcome back. It is time for our weekly checkup. The average life expectancy for Americans fell sharply again last year in 2021, marking the largest two-year decline in nearly 100 years.
Still, there have been a few brief periods when the economy has boomed. One began late in Barack Obama's presidency and continued during Donald Trump's term. After the housing crash, the country emerged from its hangover as businesses expanded and consumers spent more. The unemployment rate fell below 5% in 2016 and below 4% in 2018. The tight labor market and increases in the minimum wage in many states raised income for all income groups. By early 2020, the U.S. economy's short-term performance was as healthy as it had been since the dot-com boom 2 decades earlier. Then the pandemic arrived.
Viral pneumonia has hit central China's Wuhan city. Authorities have reported 27 cases in total.
It's a new type of coronavirus.
People stayed home and cut back on spending. Businesses laid off workers, and the unemployment rate exceeded 10%. Experts understandably worried that the economy could fall into a vicious cycle in which companies went out of business, families couldn't make loan payments, and banks went under. Many economists believe the federal government had been too timid with stimulus after the early 2000s housing crash. During the pandemic, members of Congress vowed not to repeat the mistake. They passed huge stimulus bills, which both Trump and President Biden signed. For all the misery that COVID-19 caused, it ended up being less economically destructive than the housing crash. The unemployment surge was temporary, and thanks to the stimulus, the typical American family's finances improved during the pandemic, a very different situation than the aftermath of the housing crash. In effect, Washington overlearned the lesson of the previous crisis. It pumped so much money into the economy during the pandemic that families could go on a spending spree. Businesses, in response, raised prices, and before we knew it, we were experiencing inflation. The pandemic's supply chain disruptions played a big role too. This combination, high demand and low supply, led to sharp price increases. Inflation has caused the cost of many goods significantly compared to last year. The most dramatically affected item is elementary school lunches, a cost in the U.S. that is already unaffordable for many families. Whenever inflation rises, it can remain high for years, a good instance being the inflation around the late 1960s to the early 1980s. Workers demand bigger raises and businesses, facing higher costs, raise prices even more. When inflation soared in 2021, some economists like Diane Swank of KPMG thought the pattern was repeating. This is what she said.
I do think we are going to see enough consumer strength that inflation does come down next year, but not as rapidly as it has this year. That said, stranger things have happened.
They predicted that only a deep recession would bring a return to normalcy. These dark predictions turned out to be wrong, though. Instead, inflation started falling rapidly in 2022. The end of the stimulus programs and most supply chain problems was enough to reduce price increases. The economy has again looked healthy for several months, with employment and wages growing nicely. And we have the Russian-Ukraine war. Although U.S. trade with Russia and Ukraine is minimal, the war fueled the already high inflation and slow growth in consumer spending. Even before Russia invaded Ukraine, commodity prices were surging globally owing to supply chain disruptions, adverse weather events, new waves of the coronavirus pandemic, and recovering global demand. The further war-induced rise in global commodities prices comes when U.S. inflation is already a 40-year high of 7.9% year-on-year in February 2022. Here is Bloomberg reporting that.
Economists are spot on with their forecasts. Inflation rises 0.8 on a headline basis during the month of February, and that puts it at 7.9% on an annual basis, which is exactly what was forecast, 0.4 higher. It is the highest since January of 1982.
To counter inflation, the Federal Reserve lifted its key federal funds rate by 25 basis points on March 16th, the first increase since 2018. The Fed announced plans for 6 additional quarter-point rate increases, which was revised up if commodity prices rise faster than expected owing to the war in Ukraine. Due to the risk of severe deterioration in the U.S. financial situation, this unstable economy harms the dollar's dominance. The national debt balance notched $34 trillion for the first time this year, as reported by Bloomberg.
This is the national debt clock. It's been in New York since the late 80s, and it shows the gross national debt that we as a nation owe countries, companies, and people that lent us money, almost exclusively in the form of bonds. Back in 1989, it was just shy of $3 trillion. Today, it's north of $30 trillion.
This embarrassing amount made Black Swan author Nassim Taleb say the country is heading for a debt-death spiral. The dollar is the most widely used currency in the world in both trade and central bank reserves, and it will likely stay that way since the use of the greenback outpaces other currencies by such a wide margin. According to the latest Bank of International Settlements survey, the dollar accounted for one side of 88% of all daily global trade. Meanwhile, it accounted for around 55% of all central bank reserves in the third quarter of 2023, far more than any other foreign currency. Some commentators have warned a rival currency could soon displace the dollar. BRICS nations are already trying to phase the dollar out of trade. At the same time, countries like Russia and China have proposed creating a new currency to challenge the greenback. However, those threats are pretty tame compared to the threat to the dollar stemming from the U.S. itself, due to the risk of severe deterioration in the U.S. economic situation. According to some experts like Great Hill Capital's Tom Hayes, the U.S. economy is having a Goldilocks moment. He explained that better in this clip.
Yeah, I think we finally have a Goldilocks scenario where the slowing is starting to kick in, the lagged effect is starting to kick in, and more than anything, what that means for the Fed is it gives them cover to actually pause in September, which is kind of priced into the markets right now.
Tom expects this year to be characterized by faster growth, shrinking inflation, and healthy job creation, a far cry from the widespread fears of a recession that marked 2023. The National Association for Business Economics predicted that gross domestic product, a measure of the value of goods and services, will rise 2.2% in 2024, a significantly more bullish forecast than the group projected only 2 months ago. Inflation, which drives up the cost of groceries, rent, and car insurance, among other spending categories, is expected to continue slowing this year. National Association for Business Economics forecasts that the Consumer Price Index, a basket of common goods and services, will decline to an annual rate of 2.4% this year, compared with 4.1% in 2023 and 8% in 2022. The organization further predicted the Fed would start cutting its benchmark interest rate between April and June, lowering borrowing costs for individuals and businesses. We have a contraction, but before I expose that, comment on what you've learned so far in the comment. Despite just talking about the ease in inflation, a new update shows that inflation has ticked higher across the U.S. as of last month. This was seen as a move by Joe Biden for his re-election bid. The Consumer Price Index rose at an annual pace of 3.2% in February, up slightly from 3.1% the previous month. The strength of this reading is likely to test confidence that the Fed, which aggressively increased interest rates to reduce inflation, could soon begin cutting them. According to the latest report from the Labor Department, shelter costs like rent, airline fares, motor vehicle insurance, and the price of clothes all rose last month, driving the headline inflation indices higher. Some grocery prices decreased, however, including dairy products and fruit and vegetables. While the president claimed during his State of the Union address last week that the U.S. economy was literally the envy of the world, many Americans are still feeling the pinch. Let's hear it from Biden directly.
My inherited economy is on the brink. Now our economy is literally the envy of the world. 15 million new jobs in just 3 years, a record, a record.
Inflation has fallen significantly since peaking at 9.1%, its highest level in a generation, almost 2 years ago, but household budgets remain under pressure. When the Fed started increasing rates to cool price growth, Many economists suggested the U.S. was at risk of recession. However, the economy has remained resilient, and the White House is confident a downturn will be averted. Americans' economic outlook has brightened somewhat of late. A February poll by CBS News found that people's assessments of the economy have reached their highest level in more than 2 years, although sentiment remains negative overall. With a fast-growing economy, a strong labor market, and falling inflation, the U.S. has outpaced its counterparts in Europe and elsewhere. GDP posted a 3.3% gain in the fourth quarter of 2023, far exceeding economists' expectations of 2%. That put the U.S. at 2.5% over the year, outpacing all other advanced economies and on track to do so again in 2024. Some of the reasons for outperforming other nations will be touched now. The first one is pouring trillions into the economy. When the COVID-19 pandemic slowed in-person work and social life to a halt, countries had to grapple with how to support their stuck-at-home citizenry, including many who lost their jobs or couldn't work. In March 2020, Congress rushed to pass a $2.2 trillion economic stimulus bill that sent cash into the pockets of American workers, families, and businesses. 2 more pieces of legislation followed to keep small businesses afloat and workforces employed. This was the largest influx of federal money into the U.S. economy. Some $5 trillion flowed to everyone, from individuals making an extra $600 in weekly unemployment benefits to state and local transit agencies strapped for cash without commuters. That stimulus is still credited with sustaining consumer spending, which accounts for 70% of economic activity. That capacity to spend despite high inflation has been an encouragement. Another reason I have here is the flexible job market. High inflation has been a painful experience for many of you and me. Due to this, our view has been shaped by how the economy is faring. However, a strong jobs market has helped disposable income, the engine behind consumer spending. The unemployment rate in the U.S. has been below 4% since February 2022, which is on a par with historic lows. And while prices climbed steeply, real wages have risen too. Low-income households have seen some of the strongest real wage growth. The U.S. has also enjoyed a productivity spike in 2023, growing fastest in years. The U.S. economy has been quite a roller coaster. Still, with the current trend, everything seems on the right path. Are you confident of that as well? I'll be waiting for your answers in the comments. Don't forget to like, share, and subscribe to my channel for more insightful content.